Hello again, everyone. I am Raj Malhotra, ITPM Senior Trading Mentor. So as we go into September near all-time highs in the S&P, it's very important to remember that it's a market of stocks, not just the stock market. Now, even though I've been bullish, and many times I've been on a cold island surrounded by bears, and I still remain that way into year end, it is very important to look to balance out your portfolio. Now, it's important to note that even in a bull market like we've been, not all stocks and not all sectors have to participate. Software, healthcare, energy, those are sectors that come to mind as recent laggers. And they could continue the year end or not. We have to see. In terms of other sectors I've been on my mind, there's been a really nice rally in consumer discretionary in the last month. But remember, not all stocks are created equal. Because within that consumer discretionary, there's one subsector that I think is seeing serious headwinds, and that is fast casual. If you look at here, like a stock called Cava, CAVA, this stock has dropped over 20% the last month since they reported earnings about a month ago. The similar story here with SG, Sweet Greens. That's down a similar amount. Now, both of these are fast casual stocks. They're more growthy names, but the growth seems to have slowed here, and I think the whole sector is seeing similar headwinds. Now, one thing to remember, September and October, those tend to be seasonally weak months. Now, stocks don't trade on a calendar, but just be cautious that you don't have to be all in long here. Look to balance your portfolio. Now, today, the name I want to highlight on the short side is a well-known brand and one of the original fast casual restaurants. Remember this, not all good companies have to be good stocks. And in this case, the name I'm highlighting that had been a good stock and a good company that no longer probably is in my mind is Chipotle, ticker CMG. Now, for those of you that have been living under a rock, Chipotle specializes in Mexican bowls, tacos, burritos, and it's all made in front of you where you pick out your ingredients. Hence the fast casual model that a lot of other companies have tried to emulate, somewhat successfully, some more than others. But Chipotle itself was one of the originals. And right now they have nearly 3,800 stores, mostly in the US, but also some in Canada, Europe, and also in the Middle East. Now, what I see occurring in Chipotle is what we refer to at ITPM as phase 2 X growth sell-off. Now, I'm not going to go through a whole curriculum because you got to pay for that. But phases 2 and 3 are the prime shorting opportunities. Now, if you look closely at CMG, there is a revaluation to the downside for many reasons, and it's only beginning. Now, the main reason is that the market should continue to realize that Chipotle's growth is just not existent anymore. And the company's trying to mask this fact with buybacks, but buybacks are just a short-term fix, and this will ultimately be a long-term negative, in my opinion. Now, their same-store sales, and particularly their digital growth sales, which was the reason why investors used to love this stock in the first place, the growth of the digital marketplace and digital sales, which boomed during COVID, that has stalled and has actually started to reverse, which is a death blow to any growth stock. Now, looking last quarter, Chipotle missed earnings, but most importantly, they had a big miss in revenues. Now, they reported just over $3 billion in revenues, but that missed revenues by a whopping $53 million, which is a very big miss for a company that should be relatively easy to map out their revenues. Now, this revenue miss also coincided with Chipotle raising prices. So this was a massive miss in revenues. Looking closer, comparable sales for Chipotle missed by 4%. So what that means is the top line revenue was essentially flat, up about 3%, but their total transactions fell by 5%. Now, keep in mind, their transactions fell by 5%, but they added 61 new restaurants. So this is a terrible result for an alleged growth company. Now, in addition to that data point, store-wide margins fell 150 basis points. So literally every metric was a total disaster. Now, I'm not quite sure how they get out of this downward spiral, no matter what positive spin they try. I just don't see how they can manage lower sales, lower margins. Opening more stores is just not going to get it done. And remember, they've already tried raising prices, and they can't really raise prices anymore because that will just kill demand. But if they lower prices, margins become non-existent. So what has happened? I think what's happened is people just realize we're just not paying $13 for a burrito because it's Mexican food. And Mexican food, for better or worse, is synonymous with cheap food. So it's not a luxury brand. It's a fast casual name. And $13 for burrito is just not acceptable, people, and sales are not going higher. Now, the bottom line is this growth story is over, and we are about to see a valuation collapse. Now, Chipotle has seen negative year-over-year same-store comps for 2 consecutive quarters. Their earnings are on October 29th, and on that date, you are likely to see strike 3. 3 strikes and you are out, Chipotle. Now, the stock right now is trading around $42 and has about a $55 billion market cap. So on a forward PE basis, it has about a 34 or so PE, which is very high compared to any restaurant stock or any normal stock in the S&P 500. Now, if this stock was just to sell off 15 to 20% from here, that would get it to a similar PE to McDonald's, which is a proven long-term consumer staple and a name that most investors would feel much more comfortable owning at the same valuation. But I think it's getting much worse than that. I think the valuation could actually get cut in half. Now, that might take a while, but even if that happened, its stock got cut in half valuation-wise to like a high teens PE, Chipotle would still be more expensive than a competitor like Brinker National, ticker EAT, which is the parent company of Chili's. And Chili's is actually seeing good growth. I mean, for what it's worth, if you look at Eat's last quarter, they saw revenue growth of 21% year over year. And keep in mind, like I said, Chipotle was a negative year-over-year growth. Brinker had a 21% year-over-year growth, and they're still trading around an 18 PE. I mean, could this be a possible pairs trade? Yeah, maybe. But at least the difference between Chili's and Chipotle is, well, at least at Chili's, you can get a tasty margarita. And at Chipotle, you get shitty Mexican food and heartburn from owning CMG stock. But I digress. Now, just because a stock is down a lot, like Chipotle this year, which is down about 30% as I'm filming this, that does not make it a buying opportunity. In this case, I actually think it's the selling opportunity. Now, in terms of structure, what I want to do is structure a November-October calendar spread in a ratio. Now, looking here, you could buy 20 of the November 42.5 puts for $3.08, and you could short 12 of the October 40 puts against it for 95 cents. If you did that as a package, it would cost you just over $5,000. Now, let's say that your timing was wrong and the stock went down to 35 by October expiration. I think that you would still be able to make about a 1.5 to 1 risk reward. But let's say that you got it right. Let's say the Octobers went out worthless and November's, after they had hit earnings, the stock got re-rated down pretty hard to $30 a share. If that happened, the P&L on both trades combined would be about $20,000 on a $5,000 spend, a 4 to 1 risk reward. Now, let's say it really got killed after earnings. Let's say it got re-rated in half. I think that will happen eventually. Maybe not this soon, but eventually. But let's say my timing was right and I got this exactly right. The Octobers went out worthless. The 42.5 puts that you or long are worth $22.5 minus the initial spend plus the credits you collect in October. For a $5,000 spend, you would make just under $40,000 or almost an 8 to 1 risk reward ratio. Now, again, I'm not saying that's going to happen that fast. Timing is everything, but it's important to know, even if you're bullish, that there are shorts out there. And if you're bearish, there are always longs out there. So make sure you try and get a balanced portfolio and try and win both ways. With that, I'm Raj Malhotra, ITPM Senior Trading Mentor. I'll see you guys on the other side with lots of profits. Take care.